Okay, we are on the hour, so we're going to go ahead and jump on in. As I mentioned to those who were on a couple of minutes ago, we're recording this whole online event, and we will have it posted to the Auditec YouTube channel by the end of the week at latest. So if anyone does come on late, if it's a coworker or a contact of yours, they'll be able to jump in and get the content there. So we'll also, send out both this recording and a link to the recording and the associated slide deck in a PDF form to all the attendees and those who registered. So with that, let's go ahead and jump on in. So this is, my name is Ben Evens. We'll actually do introductions in a second, but this is the second online event we've done at Auditec Solutions. Today we want to talk about performing construction audits to manage costs. Just to talk about what this presentation is and what it isn't. Auditec Solutions obviously performs this work, but this is not an Auditec Solutions delivery model discussion. We really want to make sure we're putting out content that's just valuable to users, whether they're in the construction industry, whether they're in procurement or internal audit. We'll be talking really at a high level about what a construction audit is and general rules and principles that are employed when performing a construction audit. We also will make sure we're not kind of pitching or soliciting people after with Auditec items. So if you have interest in reaching out to Auditec for additional information or potential services, please reach out to us because we don't want to make this a salesy or a solicity thing. We want to make sure we're just creating quality content. So with that, I'm going to jump in to the introductions. So my name is Ben Evens. I am the president at Auditec Solutions from Salt Lake, Utah. Originally, I'm a CPA, moved to Gilbert, Arizona when I first joined Auditec Solutions, and come from forensic accounting. I'm here with my wife and my 3 daughters, and live in Gilbert, Arizona. And Jeff, do you want to give a quick introduction?
Yes, I'd be happy to. My name is Jeff Ebert, and my background, I have worked a lot in construction. Growing up, I worked in a family construction business, and all throughout my undergrad, where I worked out in the field a lot, and then I transitioned into the office where I would help with the estimating and bidding on projects. And after undergrad, I moved into legal work. I got my law degree and I practiced law for several years, where I would do transactional based legal work. And after a couple of years of doing that, I transitioned into contract compliance auditing. And I've done that now for 5 or 6 years and have really enjoyed it. I'm currently an audit manager at Auditec Solutions. Similar to Ben, I'm originally from the Salt Lake City area. I'm currently in Mesa, Arizona. I have a wife and 3 kids, and I'm happy to be here today.
Great. And Jeff will be doing most of the talking. So I'm going to start off with, looks like we're going the wrong direction here. Let's see here. I'm going to start off with kind of the elevator executive summary of what a construction audit is. And I'm really going to turn the time over to Jeff and really act more as, someone who can ask him questions and kind of prompt his subject matter expertise throughout. So what is that elevator pitch, or what's that elevator description? So construction audit, it's a review of the various components that happen in a construction project or a group of projects, and really focused on contractual terms. Are those being followed? And are the contractors and subcontractors operating appropriately in line with those contractual terms? A construction audit team typically will review invoices as they come in from the contractors and subcontractors, and they will perform a lot of analyses prior to payment. Alternatively, in some cases, and Jeff will go into more detail on this, a construction audit can be performed in a post-payment, is the term I would use, environment, where the work's all been performed, payments have taken place, and the audit is taking place on already paid invoices. Again, I think in general we see it happen in the prepay world, but we have done quite a bit on the post-pay as well. So with that, as promised, I'm going to stop talking and I'm going to turn the time over to Jeff to walk through the details. We kind of anticipate this presentation will go somewhere between 30 and 60 minutes. We don't really know exactly where to land, but either way, we won't use more time than necessary.
I want to start out by saying that this content hits all three of my backgrounds perfectly. It has construction, it has elements of law and contracts, and it has auditing. And so this content is my favorite to not only work in, but to talk about. To begin, what is a construction audit? It's helpful to also know what a construction audit is not. A lot of times when we talk to clients who want construction audit services, as we're explaining, it sounds a lot like process they have in place. And so it's important for us to hit on what a construction audit is not. But before I do that, let's start with what a construction audit is. It's an independent review and assessment with conclusions of the accuracy and validity of transactions and operations. The element of independence is critical to an audit. That's what it distinguishes it from what a typical and routine review of a construction project by either the accounting or the team that reviews applications and approve those or change orders. That is routine and part of the project, and the purpose there is to ensure that the project continues in a timely fashion and moves forward according to how the owner and the contractor desire. The nature of having an independent team or independent contact perform an audit has different interests, and it removes some of those inherent biases. Some of those biases being, keeping good relationships between an owner and a general contractor. That's important when you're working day to day, where an audit firm can act as that independent party, where they can take positions that don't need to facilitate that same level of day-to-day operations, and can come to the table with those conclusions on whether or not transactions and operations were accurate and valid as intended. Moving into different types of construction contracts, the contract is where it begins, where the audit begins. This is the data point that establishes how billings and operations should be carried out. Some of the most common types of contracts, a lump sum contract, cost plus a fee, cost plus GMP, and a few others. Let's jump into those a little bit more detail. Lump sum contract. This historically has been a favorable type of contract because it provides so much certainty to the owner. That certainty being the price certainty. The owner knows how much they are agreeing to spend, and they can budget that, and they know that that is without some crazy circumstances, that is what the owner will be paying, subject to some change orders that are expected with every construction project. But the lump sum project does carry some risks on it. Risk to the general contractor is if the cost of the project goes over the amount, they bear that risk, and they have to eat that cost if the project exceeds the lump sum amount. Conversely, the benefit to a general contractor on a lump sum contract is that if the actual cost comes under what they have negotiated as the contract sum, they get to pocket those additional profits. Now, because that incentive is inherent to those type of contracts, it creates from an audit perspective, an inherent risk that general contractors will look to cut costs in order to increase profits. And that's one of the purposes that an audit can help bring to the table for the owner. And the value on lump sum agreements is making sure that the quality of work meets the standards that was negotiated and agreed to on a lump sum agreement. A cost plus a fee agreement, these are becoming more and more popular. And it is just what it sounds like. It's actual costs incurred to carry out and perform and build the construction project with a agreed upon fee. And that fee can either be a percentage of costs, which is common, or it can be a fixed fee amount. The risk there is if it's a percentage of costs, general contractors are then incentivized to throw additional costs at the project in order to invoice and receive their percentage fee. One of the other risks to a cost plus is that the general contractor, depending on the nature of the general contractor, if they are the type of contractor that spends a lot of money, that can drive the costs up a lot for the project, and the owner loses a lot of control, and that certainty of what the final amount of the project will cost is not there until the project is all but complete. The flip side to that is negotiating or entering into a cost plus guaranteed maximum price. And that's very similar to a cost plus the fee, but it puts a limit on the total project amount that can be invoiced or submitted for payment by the general contractor. And that's the guaranteed maximum price component to that contract. Those are becoming more and more popular that we're seeing currently. Other types of contracts, time and material, where the base of the billing is just actual time and typically negotiated labor rates for that time, and then the cost of material with usually a negotiated markup percentage. Unit price is often sometimes related to change orders, where the agreed amount is a unit price per an unknown quantity. For example, lineal feet of curb and gutter at a unit price. That's the type of contract where the basis billing is determined by that unit price. And design build are becoming more and more popular, where the owner contracts with one entity, one party who operates, is either internally operates as the architect and the designer and the general contractor in a single firm, or as a manager who takes on the risk to manage the project, and the owner contracts directly with that manager to carry out and oversee the designing and the construction of the project. For purposes of today's discussion, will be in the context of a cost plus a guaranteed maximum price. Those are because they are more common and they offer the most audit work. So from an audit perspective, we'll generally be talking in the framework of a cost plus a GMP. And I'll try to highlight areas of the discussion where a different type of contract is being discussed or makes sense to call out. Moving into the types of audits. And jumping into this, it really depends on the underlying goal of why the owner or general contractor wants to audit their subcontractors, or the owner wants to audit the project. If the goals are focused on saving costs or minimizing costs or understanding costs, then a cost audit is what makes sense. And the difference between a cost audit and a control audit is that a control audit is really focusing on processes and procedures and drills down on the paperwork of the project to look at ways to improve on those processes. And it indirectly has cost elements to it for future projects. Control audits make sense for entities who are heavily involved in a lot of construction projects, or a very long construction project that'll take the course of several years. A control audit would make sense. A cost audit is beneficial, again, for financial reasons of saving costs, recovering costs, and also avoiding costs, future costs that could come up either in that project or again in future projects. Now, when we do the majority of audits we do are cost audits, but it's almost impossible to perform a cost audit and not have elements of control audits naturally surface, where process improvements are recommended and highlighted to the owner of the project or whoever's sponsoring the audit. Another element that helps determine the type of audit is whether it's a prepay or post-pay audit. And this really hits at the timing of when to perform the audit work. And quick definitions of prepay and post-pay, it's really when is the audit work being performed before or after the payment of the invoice, pay application, whatever it may be. A prepay audit is audit services being performed before the money goes out of the payer to the payee. And And there's some benefits to doing those audits, especially in construction. It's often difficult to recover money back after it's transferred hands. It's difficult for, if in the context of an owner auditing a project and the costs and the pay applications from a general contractor, it's one of the challenges is recovering those costs after they've been paid. And general contractor is almost always more willing to adjust pay applications in real time or current time before the payment rather than after. However, there are times and types of projects where a post-payment audit makes sense. Lump sum contracts are one of those examples where a post-pay audit, because the lump sum really negotiates the entire amount. You can audit the entire world of transactions all together and validate the quality of work and the timeliness of work. And ideally, you perform and complete that audit prior to the final payment of, usually it's the retention amount, retained for purposes if there is any discrepancies or claims or disputes, that retainer is held by the owner for resolution on any claims that might come out. Jumping into planning and preparing for construction audits. This is helpful to think about from the perspective of an owner of a project and whether or not an audit makes sense for your construction project. One is timeliness. Has the project already began? Are you underway? How far into it? Is it over? If it's complete, how long ago did it finish? All of that, those timing details help understand, one, what type of audits to perform and whether or not it makes sense. Also the type of contract, obviously we've gone through the contracts, the type of contract also helps determine the type of audit to perform. The type of project as well. Sometimes our services are requested because the project itself didn't go as smoothly as anticipated. And because of some known issues, it makes sense to perform an audit. And that's a factor too, playing into the planning phase and preparing for a construction audit, is the degree of I guess, effort or resources that the audit is going to require. A lot of these audits, while the independent nature is very important, they still can be performed in-house by a different department of the owner, where that individual or that team of individuals is taking on the role of auditor from an independent perspective, where those interests are more looking to the validity and accuracy of the transactions and the operations, as opposed to the relationship timeliness and completion of the project itself. Moving into the auditing and construction costs. Now, this is the bulk of information that I like to discuss today, and we'll be hitting on a lot of the different types of costs and how to dive into those costs and what an audit looks like. While we're discussing that, keep in mind the amount of resources available to the person performing the audit. If it's internal, the level of depth that you can get into an audit is only limited by the amount of resources you have, the time, the personnel, but most importantly, the data available. Data is extremely important in performing an audit. The accuracy of an audit is 100% dependent on the availability of data. So with that in mind, jumping into the different types of costs that are commonly reviewed in a cost audit. Starting with pre-construction costs. So what are pre-construction costs? Those are typically the costs incurred in like the design phase or preliminary to actually contracting with the general contractor and getting the construction project underway. For example, doing land surveys on the land where the construction project will take place, other consultation fees, the architect fee, legal fees in reviewing the plans and the specifications and the contract templates. These are types of pre-construction costs that are real costs incurred by the owners that can be part of the all-encompassing audit scope. It also helps the auditor become familiar with the project itself. By reviewing those documents, reviewing those costs, you become familiar with who are the main players or actors or parties in the project, who's the architect, who's the general contractor, what does the overall spend look like? What do the plans and the specifications look like? These are types of things that help get the framework around all the remaining costs that are to be audited. Moving into that second topic of general conditions and general requirement costs. Here's looking at almost every single construction project will have some general conditions or sometimes referred to as general requirements. In some projects, there are nuances that distinguish between the two, but what these costs are typically general costs that are incurred with every project. Those are the common personnel from the general contractor who will be either on site or the staff in office who will be part of the construction project, looking at utilities and cleanup costs and trailer costs, on-site costs that are incurred for every project. Those general conditions typically are called out in the contract. They're definitely called out on the schedule of values. And those costs, again, depending on the type of contract, are a great place to audit and often result in some form of exceptions or findings. And the reason being, a lot of times in contracting or bidding on work, general conditions are submitted as just a general placeholder, and the actual costs rarely align with those estimated placeholders for general conditions. And so a lot of findings coming out of construction projects are related to change orders or general conditions when the contract supports an actual cost basis for the payment by the owner to the general contractor on general conditions. The next type of costs that in a common audit are subcontractor costs. And subcontractor costs, the purpose is one to review and verify the accuracy of those costs, and two is to verify the full value received from the subcontractor to the owner in the project. And the great place to start on auditing and verifying the subcontractor costs is at the schedule of values. And the schedule of values is a breakout of the contract scope financially by broken out by phase. And some of these schedule values are more detailed than others. The more detailed, the more helpful as a starting point for an audit. The next data point that is necessary to start with is either a log or an overview or workbook of the pay applications with the costs broken out. Those two starting points in an audit really help begin the overview of the costs and the breakout of which of those costs are subcontractor costs. And one of the major risks, and we'll get into risks a little bit later, but one of the major risks with subcontractor costs are credits that go to the general contractor that are not passed back on to the owner, or any changes in scope that the subcontractor does that again are not passed on to the owner. Oftentimes there's a layer of lack of transparency between the owner and the subcontractors that's hidden behind general contractors that an audit can dig down and get to that oftentimes an owner can't, even in internal audits. Again, it depends on the resources available to get that deep.
So just interrupt you real quick here, because I know a lot of the people who registered for this conference are going to be in construction themselves or in the procurement space, and we'll let you kind of continue down this list. But as issues are actually identified, and both in the prepay and the post pay model, how does that work? I mean, how do you go from, okay, we've got a problem here. It was supposed to be, some contractor was supposed to bill like this, and they build like that. How is that communicated to the supplier / subcontractor and handled in the prepay model? And how is it handled in the post pay model?
Great question. In the prepay model, it's raised to the owner, and the basis of that claim or that finding or that exception is explained and demonstrated to the owner. And then oftentimes the auditor performs the role of communicating that to the general contractor. Sometimes the owner takes that role, but usually not. So the audit firm or the auditor will take that claim to the general contractor, explain the basis for it. In a prepay model, the recommended course of action is to adjust the pay application and so that it's based on the accurate either contractual expectation of billing or the accurate maybe quantity of material or quantity of work performed. If that depends on what the finding was based on.
Okay.
In a post pay model, it depends on how far at the end of the project, if the project's complete, if there is a retainer being held, if the retainer's paid out and everything's done. In a post-pay model, it sometimes makes more sense to get all the claims summarized and taken to the owner collectively. And then discussions can be had on how to present those to the general contractor and recovered that way. Depending on the nature of the claim, there are insurance underwriters and there are other sureties, performance and payment sureties that, again, depending on the nature of the claim, that claim could be taken to them as a third party who's responsible for those costs if it's an insurance issue.
And I'd imagine, I don't know the answer to this, but I'd imagine in a prepay model, you're going to have a higher realization rate on recovering those claims because you haven't paid them yet and they just have to rewrite the invoice.
Almost always. In a perfect world, I would prefer to audit a cost plus a fee with the guaranteed maximum price in a prepay environment. And doing a series of projects, if it depends on the client, if there's a series of construction projects that is underway by the same general contractor, and doing those together is the ideal type of construction audit environment. And then it just goes down from there, depending on if there's only one project available or if there isn't any active construction projects going on with that general contractor, then you have to do post-pay environment.
Great. Okay, I'll let you continue on.
The number one identified findings in my experience is related to change orders and the costs for change orders. Change orders can be a heavy finding topic under almost any construction contract, regardless if it's lump sum or if it's a reimbursable cost basis of billings and pay applications. Change orders change the scope of the project generally, and they always change the billing expectations. And change orders sometimes are contractually agreed to be billed differently than the project. Sometimes even a lump sum project, a change order will be like a time and material change order or a unit price change order basis. In a guaranteed maximum price contract, a change order, it might not even affect the final outcome of the cost because it's all cost based anyways. It just changes the scope of the project that's going to be performed. From an audit perspective, when we're auditing change orders, we begin with, if available, the log of change orders, change order log of the entire project, if it's a post-pay environment, if it's prepay environment, as change orders get submitted by the general contractor, we review those in real time, review the basis of those, and then as needed, determine the quality of work being submitted, and make sure that it's in line with the specifications for the project. And always check that the scope of the change order is not already included in the scope of the original project. If there's not a true change in scope, then a change order isn't warranted and could potentially add additional costs out of the owner's pocket on a faulty basis. Moving to the next type of cost, self-performed work. This is looking at work that's performed by the general contractor themselves, and there's really one major component to self-performed work, and that's the next cost is labor and labor burden costs. While labor and labor burden costs can also be audited through subcontracted work, those are the primary components of self-performed work that we like to audit. And what we mean by the labor and labor burden, labor is the rates or salaries that the staff on site are actually paid. The labor burden is all the additional costs related to that labor. Those could be payroll, taxes, FICA, FUTA, SUTA. It can be workers' compensation, other insurance, other benefits. What we found is oftentimes labor burden is bid into the contract as a percentage of labor, and getting into those details, the labor burden breakdown oftentimes leads to some variances between what was being billed as labor burden, what the actual cost of labor burden. Some of the more detailed examples is the state unemployment tax has limits to it. And if you put the full amount and the project carries on for 12 months, full year, multiple years, oftentimes that SUTA amount, gets normalized across the entire 12 months when in fact that cost isn't incurred for some or all or a portion of the construction project itself. Some of the other common costs that are audited: equipment rental costs, insurance, bonding, owner construction in progress. I'll hit on equipment rental costs, just being mindful of time and other topics we want to talk about. Equipment rental costs, there's really two different ways to look at, or there's two different costs that are incurred. One is whether or not the contract allows equipment to be billed to the owner for general contractor owned equipment. Sometimes contracts are silent on that, and those costs get submitted as a cost to the owner, as though the owner is renting that equipment or the usage of the equipment for general, and the basis off from the general contractor is wear and tear on the equipment throughout the project. Sometimes contracts are clear on contractor owned equipment, on whether or not those billings are included in the fee. Oftentimes that's part of the overhead fee, the markup fee, that is overhead. And if those equipment costs get somehow included in change orders or the pay application, the reimbursable costs, that equipment, that would lead to a situation of double billing for that item. The second type of equipment cost is equipment that is rented from a third party, and often easier to audit because you can review the third-party invoices and validate that the equipment was actually, that cost was actually incurred, that the amount of that cost was accurately billed. And then the final step in the audit work of equipment costs is to make sure that the way that the equipment cost was billed was in line with the contract, meaning was it a cost pass-through expectation, or was there a markup allowed contractually to be included on that equipment rental. Quickly touching on the last 2 points, insurance and bonding costs. Type of audit work that goes into there is one, ensuring that the insurance and the bonds that were represented as obtained were actually obtained. And that can be done through reaching out and contacting the surety or the underwriter, verifying that the amount of the policy and the bond is what was represented, and getting that in writing, and ensuring that to the owner as a cost avoidance measure, that if down the road a claim needs to be filed against the underwriter, the insurance, that policy is valid and in place. And owner construction in progress costs. During the construction project itself, just through the management and overseeing while owners typically try to minimize that management, those costs still get incurred, traveling to the site for inspections, progress inspections, safety inspections, and looking at those costs as well. Through the audit work, and Ben, I think this is helpful. Your question before, when you're asking, okay, well, what comes out of the audit work, and how do you handle those claims? A lot of claims, they result from these types of risks, right? And some of the common risks to keep in mind throughout the audit, the highest potential risk is change orders. Typically in the audits that we perform at a high level, if it's a post-pay environment, we'll take all change orders and quickly look at the quantity of change orders and the total spend of change orders as it relates to the expected or original contract sum or project sum. And a general rule of thumb, change orders, will typically be about 5%, often up to 10. If change order amount is over 10%, that's a little bit of a red flag. While those could be valid, it definitely warrants looking into and understanding why the change orders were such a high amount. The contractor and legal risk, again, this looks at the nature and the base of the written documents themselves and the contracts themselves. And through an audit, as the contract itself is reviewed, building out a risk matrix based solely on the construction contract helps identify or at least flag potential risk areas that often get forgotten or overlooked once you get into the billing details side of the project, where you're looking at errors in the billings. And perhaps you forget that a provision in the contract calls out for a specific performance of service by the general contractor that was never performed, but was included in as a basis or a component of the lump sum amount. Budget risk and design risk. I think we covered those going through the different types of contracts. Cost containment risk, that is the nature of cost audits, is containing that risk. That's the value of performing these types of audits, is that cost to the owner, one, gets the stamp of approval through after an audit that the adjusted final costs are certified, verified, and accurate. Liability, surety risks, I think we've already touched on those as far as cost avoidance measures down the road. Quality risk. So going back to change orders and in the nature of lump sum contracts, one of the biggest areas to actually audit in a lump sum agreement, through our discussions, a lot of times contractors will say it's a lump sum agreement and we build either that amount or less, there's nothing to audit. Quality is a huge component of at-risk components of a lump sum agreement. Was the quality paid for actually received? Was the scope of work paid for actually received by the owner? And then safety risk, that really hits on control audits and a cost avoidance as well, making sure that the safety measures in place aren't going to lead to an unfortunate claim, right, for either injury or death. But from a control measure, ensuring that all OSHA guidelines are being carried out and respected on the project.
I think a call out here too, when performing this work on all these risks, is when you're performing construction audit that looks at these items, you really are driving to create a culture of compliance. So not only within the organization that's performing the construction audit, kind of the sponsor organization, but also the contractor and the subcontractors. More people being aware that the stuff is being looked at in this manner means that stuff is generally going to be more orderly. Doesn't mean errors won't occur, doesn't fix everything, but people behave better when being watched, right? So there really is in all of our work on the contract compliance side, but specifically in construction for this conversation, performing the work creates a culture of compliance across all the parties involved in the relationship.
Especially on prepay audit, if a general contractor knows that everything being submitted is going to be audited and reviewed, that culture of compliance, it keeps those costs down throughout the entirety of the project, as opposed to trying to recoup those or cover them at the end of the project.
Yeah, absolutely. And that kind of leads into another question. I don't know where to time this, so I'll just ask it now. But so you talked about how claims are different in a prepay model as opposed to a post-pay model. How do you wrap one of these things up? Like, how does this thing get, and I think it's going to look different under both models, but how do we get to done at the end of an audit, whether it's an audit on a specific general contractor or a specific project?
So let me start by saying every construction audit that I've ever been a part of has a finding in it. No project is done perfectly. Now, with that being said, the next step in a finding or an exception through the audit work is bringing those to the owner. A lot of those findings are findings that the owner weighs the cost benefit analysis and determines some of them aren't worth pursuing, or some of them it was still within their acceptable scope or range. But when we get to issues that are outside of what the owner expected or it can tolerate, wrapping up those findings, recovering those costs is one of the primary resolutions. The second resolution is ensuring that type of issue doesn't continue if it's a prepay, right?
Yeah.
And it's training, it's identifying the root cause of that issue and training and explaining to the general contractor or whomever's being audited, explaining to them what happened, what we saw from the audit perspective and why it resulted in a finding, and discussing with them or letting them take it to their team and having internal discussions how that can be resolved. But the first component is a financial component and recovery of those dollars. One way to handle it is through that retainer portion of the project that gets withheld with every pay application for this very purpose. If there's a dispute on billings or if there's a basis for overbillings, that retention can be used to resolve those overbills. If it's a prepay model, the solution is just don't pay the invoice.
Yeah. Yeah.
You don't pay the invoice, it'll get fixed, and another invoice will be submitted, or a pay application will be submitted that's been adjusted. And once it passes through the audit review and approved, then it'll get paid.
Yeah, and I think under either model, it benefits everyone involved if a report comes out at the end of it to kind of show where things were happening, whether it's prepay or post pay. Having some type of reporting going out to all parties, so there's a high level of collaboration at the end, is also, I think, a best practice. Would you agree?
Absolutely. One of our first slides, the definition of what an audit is, it's an assessment with conclusions. That part of having very clear defined conclusions of the audit is what makes an audit. Yep. It's not just, as opposed to just a review and moving forward with the project. A lot of those reviews are done internally, and audit will bring forward conclusions on the health of the billing practices and the accuracy of the same.
Great. Okay, and I think we're jumping to the end here. So I wanted to throw in a few other items here. So we have kind of an eclectic group of registers, those who registered. Some are in the construction space, some are in procurement, some are in internal audit. This work can be performed internally by an organization. It's typically, as Jeff kind of highlighted early on, is typically going to be performed by an independent group, an audit firm. If it's something your organization is considering, and this isn't a pitch specifically for Auditec, On the prepay model, typically it's going to be hourly or a fixed price based on a specific project. And on the post-pay model, often it's contingent, where the third party only invoices their client for amounts that are actually recovered. Either way, the big thing I wanted to hit on here is the concept of this work being self-funded. So whether someone does this internally or externally, as Jeff said, there's almost always findings. There is always findings, and there almost always is recoveries, I guess. Meaning that any cost that's incurred within your organization or outside of your organization through third-party contractors is going to probably be a fraction of the amount actually saved / recovered. So it's one of those few initiatives that actually pays for itself. And if it's handled correctly, it can be a revenue line item essentially on a budget as opposed to an expense line item. The other thing I'd throw out that I just want to restate again at the end of this discussion is the purpose of this is for us to give an overview of what a construction audit is, get to some detail. Jeff is a JD, so he's got a lot of detail oriented approaches to explain this stuff. But if you have any questions, feel free to reach out to us at Auditec. I mean, we've got CPAs, JDs, CFEs on our staff, and we can kind of answer any of those questions, whether or not you decide to use us as a provider or not. We're not looking to have, again, this be a pitch. Some people came mid discussion. This isn't a pitch for Auditec. That being said, we would love to work with any of you. So feel free to reach out if there's any interest there. We will be sending restating this again, because we had a lot of people jump in the middle. We'll be sending a link to our YouTube channel once we post this video to that channel. And we will also be sending out a PDF that has all the slides in here. So please feel free to reach out to me, Ben Evens, on LinkedIn. You probably have my email as well somewhere in the meeting invite. If there's any questions on the content or you'd like any kind of clarification, and pay attention to the Auditec LinkedIn page is where we really kind of drive everything on our online events for future online events. So appreciate everyone who's participated. In the future, we might start doing a little bit more on the polls and questions, but with this platform that we're using, the Zoom webinar being a newer platform for our firm, we want to make sure we get our arms around just being the speakers at this point. So I appreciate everyone, and have a great Wednesday leading into the weekend eventually. Thanks. Bye.
Thanks.